All right, so here we are looking now in chapter 6. We're looking at variable costing for management analysis. And in this particular part of the chapter, we're looking specifically at the effects of inventory. Now, what I will tell you is that the income from operation will vary under both methods. Those methods being variable costing and absorption costing. And it all depends on the change in inventory. So before we get into this, what I want to remind you of is when we're looking at basically we're looking at income under two different methods. And depending on what method that the organization adopts, the income will vary, right? And so because we're within an organization, we're usually looking at variable costing. And so what I'm doing is taking you through this process and showing you how our income from operation will be different under two different methods. One is required under GAAP, which is absorption costing. And then the other one is more so for internal decision making. It's not required under GAAP, and that one is variable costing, also known as direct costing, okay? So going back to this, there's three different scenarios that will yield very different income from operation. And we'll go through each of these and do examples of these, okay? So in scenario number one, we have no change in inventory, which means everything that we make in this particular example, everything that we make, we sell, okay? So make equals sell, right? Everything we make, we sell. There is no ending inventory, right? No ending inventory, okay? In this particular example, that is scenario number one. Scenario number two looks at there may be an increase in inventory. So what that means is you make more than you sell, right? Which will result in increase in ending inventory, right? So everything you made, so maybe you made a total of, sorry, let me erase that. So maybe what you did, you maybe made, I don't know, 7,000 units, but you only sold 5,000, right? So your ending inventory would be 2,000 units, all right? So in that case, in scenario number two, you would have an increase in inventory, okay? All right, let's talk about scenario number three. Scenario number three is a little bit different. Scenario number three looks at you sold more than you made. So you sold more than you make, which means that you're borrowing from the prior period. You're borrowing from a prior period's inventory, okay? So let's take, for instance, that you made 7,000 units in the month of July, but maybe in that same month, you sold 9,000 units, where 2,000 of those units would have to be borrowed, or you're depleting some of maybe June's inventory, because again, you only made 7,000 units, but you sold 9,000 units, right? So in that case, you would have a decrease in inventory because you're dipping into what you made in June, all right? So now what we're gonna do is look at how does our inventory and our income, sorry, more so, how does our income from operation, how is that affected given these three scenarios, okay? So that's what we're gonna look at now, all right? So in example number one, or if you're following along with the handout, here's our first real example, right? And so it says, assume that Martinez Company manufactures 15,000 units, which are sold at a price of $50 per unit. The related costs and expenses for Martinez are as follows. So it's asking us to prepare income statement using absorption costing and variable costing. Variable costing is a little hidden, but no worries, we can still tackle this. So I'm gonna switch applications to make this a little bit easier to go through, okay? So, all right. So here we are again, the same example that you guys are looking at on the handout. So hopefully this makes sense. And so again, here's the part that was missing. To prepare here. To prepare an income statement using the absorption costing and variable costing, okay? Now this very first template that I've set up is for absorption costing, okay? So we've seen that one before, and so what we're going to do is now look at how our income from operation will look like under absorption costing. So from here, let's just go and put in our plug in this information into absorption costing. So we're doing the income statement. Okay. All right. So the first part is sales. So it told us that we manufactured a total of 15,000 units and we sold it for a price of $50, right? So to do that calculation, what we all know is to generate income or to generate sales, we're going to do sales amount. So sales should be calculated as 15,000 units times $50 per unit. Okay, so if we did that calculation, 15,000 units times $50 per unit, we come up with a total of $750. Okay. All right, next, we need to now subtract out our cost of goods sold. Now, our cost of goods sold in this particular example, remembering under absorption costing, we do not separate fixed and variable overhead, right? It's all counted as one, okay? So our under absorption costing, our total cost of goods sold is going to be $35 per unit, okay? So if you did $35 per unit, so we're going to subtract out here, subtract out cost of goods sold. So we would do $35 per unit times the 15, that's wrong, times the 15,000 units that we sold, right? And if we did that calculation, it comes out to 525,000. Okay, so hopefully that's making sense. So as a result, if you're following along, our next one is our gross profit. So our gross profit, once we do this calculation, is 750,000 less our 525,000 in cost of goods sold, comes out to 225,000 as our gross profit. Now the next step is to subtract out our selling and administration expenses. So here it is. It tells us that our selling and administration expenses for 15,000 units comes out to $125,000, right? So I'm just going to put here selling and administration expenses. Okay. So once I subtract that out, $125,000. My income from operation in this particular example is $100,000. This is my income statement under absorption costing, okay? So hopefully that made sense to you or you followed along. Of course, my handwriting is not the best, but hopefully you got a good understanding of how we went about doing that. So now with that, I am going to show you how a variable costing is a bit different, okay, using the same information, okay? Okay. All right, here we go. So here's our template for variable costing. Okay, so let's start off the same thing. So our first thing we have is sales. And we're going to calculate sales exactly the same. The way we do this is we're going to do our the number of units, which is 15,000 units, times the selling price of $50, right? So our sales amount is 750,000. Now what makes this different is now we're going to subtract out our variable cost of goods sold. Now our variable cost of goods sold is $25, right? And so the way we come up with this number is we're going to do $25 per unit times the 15,000 units that we sold. Okay, so our variable cost of goods sold comes out to $375,000. Okay, so then our manufacturing margin is the difference between the two. So if I did my 750,000 less my 375,000, I come up with $375,000. Now I'm gonna subtract out my variable selling and administration expenses, right? So I'm following along with this template here. And so it tells me that my variable right here, my variable selling administration expenses is 75,000. So that's what I'm gonna subtract out here, $75,000. All right. So then I come up with 300,000, and that 300,000 represents my contribution margin. Okay. All right. Now, lastly, what I'm going to do is I'm going to subtract out my fixed cost. Okay. And so my fixed cost is divided into two different amounts. We have my fixed manufacturing cost, and then I also have so I'm gonna push it over a little bit, sorry. So I have my my fixed manufacturing cost, which that comes out to my fixed manufacturing cost is 150,000. So hopefully you guys see where I'm pulling this from, 150,000. And then I have my fixed selling and administration expenses that I'm going to highlight here. Fixed is this one, 50,000. Okay, so hopefully you understand where I got that one from. All right, so that one's $50,000. So my total fixed cost comes out to is these two added together. So that is $200,000. And so that is my fixed cost. And so after I did that, my income from operation comes out to the difference between my contribution margin less my fixed cost. It is $100,000. Okay. So what you should see in this screen right now is that what you should see from my screen right now is if I make everything I sell, or if I sell everything I make, my income from operation under both methods will yield the same income from operation, right? So variable costing and my absorption costing will be the same. Okay, our income from operation will equal the same amount when we sell everything that we make. Okay, so I'm gonna switch really quick and show you the slides. So here, again, when the units you manufacture equals the units you sold, income from operation is the same under both methods. Here's your 100,000 and here's your 100,000. Okay, so with that, I'm going to end this video, and then I'm going to show you another example, which is scenario number 2.